you say when you say that Shelbyville is 20 minutes from here, is here like the airport is here where the event is here your house? How far is Shelbyville from downtown?
30 minutes from downtown, about 18 minutes from my home.
All right.
So
Wait,
you
why
can
are we talking about
any place
Shelbyville?
in Louisville in 20 minutes.
What's in Shelbyville?
Claudia Sanders, the Kentucky Fried Chicken, Colonel Sanders' wife's restaurant, the original KFC restaurant.
Now, is she from Kentucky? Because I
No.
don't think he is.
No, and he's not either. He's from Indiana, so we can't claim.
I was hoping maybe one of them was.
No, but think about this. It wouldn't sell as Indiana fried chicken. So.
All right, all right.
No.
Well, for those of you that are joining, you're not crazy. David Kittle and I are a little fancy today. We're going to tell you why here in just a few minutes. Would love some guesses as people are joining us. David, I thought I saw you with a little sniffer of bourbon.
You did.
What are you drinking, my friend?
Well, this afternoon, since I am off the clock because you allowed me to have the rest of the day off, Melissa, I'm having some 1792,
Okay.
and it is called 1792 because that's the year Kentucky became a state.
That was Kentucky became a state. Okay. Rob, are you getting in trouble?
Not yet. Not
I
yet.
did not used to dress like that at work. Chris Robertson is putting in the chat that this apparently used to be my daily attire at work. I did not. That was not true. I'm not a hat fan, but I'm doing it for us today. And I'm doing it for us today because we have an upcoming conference in Louisville.
Louisville,
Hold on.
Louisville,
What?
Louisville, not Louisville or Louisville. It's Louisville.
Okay, Louisville.
Very
Y'all all know that I know how to say Louisville, right? But it's so much fun to say. Yes, it is Louisville. Louisville.
So it's not Lowville.
No, no.
Hey, so can I tell them something about the convention?
Yeah, of course.
So we're coming to Louisville, March 24th through the 26th. That's 6 weeks away. And so I'll let you segue this in. But we're going to be raffling off this bottle of Pappy Van Winkle. Goes for about $1,500 to $1,700, depending on where you go. And a lucky winner will win this while they're at the conference and registered. So looking forward to that.
Awesome. We're really, really excited. Benefits of that auction are actually going to First Home IQ, which if you guys do not know about that platform, just send us a DM. We'll get you hooked up. All right, so enough about Louisville. If y'all have questions, we would love to have you there. It's going to be so much fun. We've got some Derby themed events. We have a reception at the Louisville Slugger Museum, and then we have a Bourbon Trail event as well. So lots of fun, but also fantastic mortgage information. Sandra Thompson's going to join us. Julia Gordon's going to be there. So lots of really good content, and like TMC likes to have lots of fun at the same time.
Well,
so
good.
David, thank you for joining us. For those of you that do not know David, wave and say hello to everybody. David is our CEO and one of the founders at TMC. We're happy he could join us today. Thanks for jumping on and matching my hat.
We did. Unfortunately, can I say it's in Clemson colors?
It is. And why would you wear Clemson colors, David?
Well, because, well, we were going to talk about this Monday morning, but you won the game, but I won the bet.
Still won the game.
I still won the bet, and you owe me.
All right. For those of you that did not know, Kentucky and Clemson played in the bowl game. If you were not watching that episode of the Rundown, it was a ton of fun. I was wearing like full Clemson gear because it was in the middle of the bowl game. We were in the fourth quarter, and actually somebody there told me the score as we were as the game was finishing up. We were finishing up the Rundown. So Lots of fun, but we did win the game. But the bet was that the bet was on the Vegas line, and we won by 3, and the Vegas line was 3.5. So
What a
we kind
great
of
bet.
called that draw. All right.
Well done.
Thanks, David.
Everybody in Louisville. Thank you.
Okay. Let's
Bye-bye.
get to, thank you, Darren. Go Tigers. All right, I've got to take off this contraption. Let's get to real mortgage stuff. We have a very special guest with us today, Skylar Olsen, who's the chief economist at Zillow. We are so excited that you're here to join us today and share lots of fun data and tell us what the heck is going on in the mortgage market too.
Yeah, right. Yeah. Thanks so much for having me. Always a pleasure to be here. We're actually at the top of every month is when we have new data fresh from the month before. So, always lots of things to talk about. Never a dull moment anymore. Seems very true in this market.
That's very true. You actually published, I think maybe a few weeks ago, a month or so ago, your 6 kind of housing predictions for 2020.
Oh, yeah.
Do you mind sharing some of those with everybody?
Yeah, absolutely. Let me start with one that probably got some of the most pickup after we shared it. And that's that the new starter home will be a single family renter. And let's talk about that because, a lot of that is driven, of course, by mortgage rates kind of up back to more historical norms, because let's be real, 3% is not very normal and was like highly advantageous. Now that mortgage rates are up at 6.5 and maybe moving up back to 7, we'll see, right? And home values have not fallen very much at all. And are still around 41% above pre-pandemic levels. That's a big affordability challenge for someone to move over, becoming a new homeowner. And to make matters worse, new listings remain very low as existing homeowners are locked in, right? So that means people are renting for longer in their life, but their life still looks like what they want their life to look like, which means they're seeking out single family rentals to get to these new neighborhoods to kind of fulfill their vision. And I think that's an important thing to remember then when we think about, housing markets to come, right? Is that there are a lot of people of that generation looking for that vision. And so the big question becomes, when will the housing market maybe unlock again to provide those opportunities?
Yeah. Your one of your kind of predictions, or I think you called them resolutions because it was at the beginning part of the year, but
well, I think it was also because there were hopes kind of layered in.
Okay. All right.
Well, yeah.
But one of them was around the opening up of the market, like more
Yeah.
homeowners will decide to sell.
Yeah.
I mean, I don't know if you had like an 8-ball or a crystal ball or anything of that
Yeah.
nature. Most
Yeah, my
everybody on this
gosh.
call would be like,
Yeah.
confident bit to find out.
Right, exactly. Yeah, this is, I think, what we all, especially people maybe that work in housing, that can really intimately feel how light we are on sales activity or listing activity, that we're kind of desperate for, right? Really waiting for the market to unlock. And, just to, so by law, this is a mortgage audience, so I know I normally probably don't have to explain this, but the idea being that you have such a majority of existing owners that are holding on to low mortgage rates in the 3 to 4% ballpark, right? They would, they're very advantaged affordability wise on a monthly basis. And if they were to move out and pop into the higher rate, right, that would hit their monthly budget for sure. Well, that was, very deep lock-in. We saw the worst of it was probably in around July of last year. We had 35% fewer new listings than we would have seen in the normal housing market pre-pandemic. And that kept inventory low and kept the competition on housing values, so housing values couldn't fall, right? And then actually if you guys remember the end of last year, right? Remember when we went up to mortgage rates near 8%? Something interesting happened. We actually saw owners come back to the market in a bit more readiness. And you think, oh, why? You got more locked in, you would come back. But at least that kind of mortgage rate swing probably dispelled some owners from waiting, right? And putting off a lot of those fundamental moves. So we were bouncing around and got back to halfway back. So worst it got was 35% down. Then we were hovering around 12% down for a couple of months. To be honest, the January numbers that just dropped were pessimistic again, that fell back again relative to normal. But in the pandemic era, Januaries just have been hard, have been particularly light. Think about very bad flu seasons, think about that challenge that we kind of more have in this new environment. So we're still hoping that that ramps up. And actually this January was still 6% higher than last January. So it's still getting better. 250,000 new listings came to the market in January. 6% up is still good, but remarkably low, honestly, still relative to last year. Other signs that it could still be getting better comes from our surveys of owners. Hey, how many of you want to sell in the next 3 years? That's elevated when rates are high because people are putting off these fundamental moves, because of this affordability disadvantage from the higher rates. But something interesting is happening now, which is the folks that have higher rates, say above 5%, and the folks that have below 5% mortgage rates, the owners, they're answering this question for the first time in a long time very similarly, right? Which means we're starting to think people are getting used to the higher rate environment, right? And are feeling that lock-in less. Does that mean we think they're going to come flooding to the market? It's like, no, they still are advantage affordability speaking. But when that fundamental move kind of happens and changes, we should hopefully, knock on wood, everybody, start to see that new listing volume come back up. But we're pretty deep down. So this is probably the trough on sales activity. We hopefully see that recovery from here, but it's probably going to be a slow one. It's just the reality that we're dealing with.
Well, Rob, we did not talk about where in the world you are. I keep getting distracted by Skylar's amazing data, but also you kind of look like you're at
The blinding light, Rob, the blinding light.
Yes, don't go to the light. Don't go to the light. Before I talk about that, Skylar, I'm asked regularly, once or twice a week, our rate's going to drop because of the presidential election, right?
Yeah.
I always say nobody has a crystal ball and nobody can predict, what they're going to have for lunch Monday afternoon, much less rates, 9
Sure.
months now.
Yeah.
But looking at historical election market behavior, do
Yeah.
rates tend to drop during presidential election years?
Yeah, I think, so the evidence is very mixed, actually, right? And that would make sense. Like different presidential elections are going to bring us different concerns at that time. Other things are flowing in and happening. And we also have to remember, though, that this presidential election, maybe not the most normal one. I think this is bringing with it a heightened sense of uncertainty in terms of what happens next. So actually, a lot of mortgage rate forecasts, and if you look at forward curves, say in the financial market that reflect the 10-year treasury, have a shape where people are expecting the rate to come down further towards the end of the year as we do approach that moment. There's other reasons to have that shape, though, too. If anyone was kind of paying attention to financial news, the chair of the Federal Reserve came out last weekend and talked about how there would not likely be rate cuts this first quarter, right? So putting back the idea of softening interest rate pressure also to the end of the year kind of coincides with that. But I do see a lot more mortgage rate forecasts where people are saying, hey, we can't really predict forecasts in the near term. So think about, where they are moving forward. But towards that end of the year, we might start to see rates come down. Honestly, that messaging sometimes makes me worried because I think folks will get locked in if they anticipate future improvement, right? They're going to wait for something that they might not be able to count on. And this is a market that could really use the activity.
So it's not so much the incumbent putting pressure on the Federal Reserve to lower
No,
rates.
I don't think so. Plus, I wouldn't, wandering into the relationship between, how those two kind of bodies of policy work together, which they do. And it's there are important checks and balances kind of in there. It's a complex one and would change a lot over time, depending on, this Fed, the way that they talk as well, is and has seemed to pan out and show itself to be very data driven, right? So what have they seen? They've seen kind of in these current last 6 months, the month-over-month pace on core inflation is back to target. But what they also have not seen is pain coming on that, you know, in the headline numbers on the labor market. So we still have low unemployment. We still have fairly consistent, though softer job growth. And right now, what that sort of looks like is the Fed affecting the soft landing, unwinding its balance sheet fairly successfully. So in that way, I think, you know, they're taking that pressure down off of interest rates. And I think that dynamic, we don't even have to involve, I think, the idea of that pressure that the Fed would have from, you know, in a political sense, to still be going through something that would feel uncertain and might impact the incentive that the market has to, you know, return to kind of these safer assets that would then put downward pressure on mortgage rates too, right? The counter-cyclical nature of mortgage rates might shine through in that way.
You know, you're known for looking at consumer behavior
Yeah.
and really digging into the weeds in terms of consumers. And there's a lot of talk out there about the credit reporting mechanism, credit
Mhm.
scores, and so on.
Yeah.
Do you think, as an industry, well, new paragraph. People will throw in my face, well, when's the next housing crash?
Oh,
And
okay.
I will tell them, you know what? I personally don't see one. I could be wrong, but given the amount of equity that's out there,
Yeah.
given the ability to repay based on credit scores, given the low existing mortgage rates that so many borrowers have,
Yeah.
I don't see a housing crash. Do
Yeah.
you think that the market is treating the credit? Do you think the ability to repay and using credit scores, and I don't know if you follow the changes in credit score modeling that
Mm.
or evaluation that are coming down the pipe in some
Yeah.
year, but
Yeah.
how does all what do you see in terms of credit scores and the credit industry impacting housing going forward? Or is it
Yeah.
already a pretty good place right now?
Yeah, I mean, I think, you know, if I can kind of tie together the two themes that you're weaving around here, which is this idea of like, you know, did we bubble forward by having low rates, you know, around 3% for so long during the pandemic? And do I expect a crash? You know, I agree with you there. And then that follows up with saying like, yeah, and we would only have a crash if we felt like the financial kind of situation was very much so at risk, and we would see more delinquencies, and, you know, and the credit worthiness of the buyer population in general, is that at risk? No, right? And so let's play, you know, some of that out. Like, yeah, we do not see elevated delinquencies right now at all. It remains at record lows. There's some uptick from extraordinary lows when people had forbearance and, you know, lots of opportunities to refinance and handle one's budget, right? To avoid that kind of risk. So yeah, I don't know where the supply comes from to bring prices quickly down. Home values were up 3% from last year. By the way, that doesn't mean that list prices can't come down because list prices, remember, have, you know, an adjustment to it. Sometimes we have a swing in purchasing power when mortgage rates change. Mortgage rates can, you know, change a little bit, and that purchasing power, you know, can fluctuate quite a bit. And so you can update those list prices. But also it's just hard to price when the volume's out there and the sales are so low, right? So buyers should still feel free to bargain, you know, down list prices, and they will be in a better bargaining seat moving forward. But yeah, prices are not coming down. No crash expected, right? And then when we turn to the credit side of the picture, you know, what we are talking about, if we would be talking about interest rates coming down, would be it coinciding with, you know, more job loss and a recession, right? And in that sense, you know, the credit worthiness of a large share of the population, you know, generally does, you know, kind of struggle there. But with rates coming down, and, you know, honestly, for the population that tends to be owner ready to move forward, we don't see too much risk there in the market. Now, there's plenty of places where say insurance markets are really struggling across, you know, and that's definitely, that becomes a local, you know, think Florida, think California. That's like a whole nother challenge. So there's, it's not that the whole system, you know, hunky dory, right? But at least in the element of, do we expect, you know, a credit crisis? No, no, yeah.
I agree.
Yeah.
Somebody flashed up betting on the ponies. I'd rather be talking about betting on the ponies than predicting interest rates. And I'm ready. I'm ready because Melissa, I am in keeping with the Louisville. How did David Kittle say
Louisville.
it?
Louisville.
Louisville.
Louisville. I am at a place called Golden Gate Fields, and I'll swing the camera around here a little bit so the lighting, you might be able to see via the lighting.
Yeah, beautiful.
It is very pretty, and at some point during our call, they may bring the horses out to warm up. But the interesting thing, the reason why I wanted to come here is mainly because I'd never been here, but B, they were going to close this facility down. And it's right, like I'm looking at Berkeley, the Berkeley Hills, for example. On the other side of this building, you've got a full-on view of the Golden Gate Bridge and the San Francisco Bay and right out to the Pacific Ocean. But they were going to shut this down a year ago, and this property is much more valuable in some kind of mixed use.
Mm,
You know, I don't know what they're going to put here. I'm sure they'll pave it over and put up, you know, $1 million places. But it's they put off the closing for a year, so I wanted to come, and they have horse racing today, and I haven't been to a horse race in 30 years, so maybe I actually will bet on some horses. So anyway, that's where I am, Melissa, in keeping with you wanting to promote next month's TMC event.
That's right. That's right. In Louisville. Maybe we'll have you out at the oh gosh.
And we were talking about Shelbyville, the original Kentucky Fried Chicken. I may come in a day early to make the drive out there to check it out. I've been told that I should go, even though I'm not a huge Kentucky Fried Chicken fan. You know, it's a historic restaurant. Like the Colonel's wife is still there. So
I want to go with you. If I'm there, we'll go together. Thank you, Dave and Stephen. Churchill Downs. That's where my head was going. I think we need to take a trip to Churchill Downs while we're there. Y'all could read my mind. All right, so can we get back to some economic data? Is that okay?
yeah.
We, you know, obviously we've talked a lot about inventory. We've talked a lot about kind of list price. You know, Rob mentioned you do have a specialty in consumers and kind of understanding consumer buying behavior. I'd love to hear a little bit more about what you're hearing about consumer confidence, if it's still as big of an issue in the marketplace as I've heard it is, or are we starting to see some relief where people are starting to, you know, feel that rates are normalized, so to speak,
Yeah.
and they're in this kind of new space that they're going to have to navigate just differently.
Yeah, I think like when you think about, so it matters a lot, you know, where we are or where the mortgage rate is, right? So for example, just to kind of put your hat on, you know, think about that consumer perspective, but think about the options that the consumer is weighing, right? And as an economist, you know, we do a lot of surveys to kind of think about, you know, what a buyer is like and what a buyer is motivated by. So for example, we know that, you know, so many moves coincide, for example, with other major life events. We know that, you know, buyers still have high aspiration towards home ownership, that it's beyond the financials, right? For someone, you know, it's a lifestyle that they're kind of seeking. They have this vision, right? Okay. So there's this buyer, they're like previous generations and they're looking for this picture for themselves. And when mortgage rates were up near 8%, to become a new homeowner would have probably lost you around $200 relative to renting the same quality home on average nationally upfront, right? The whole idea is you would lock in for 30 years and then rent could continue to grow, right? But you would have that advantage. But upfront, that's pretty salient to someone, right? Now that mortgage rates have come down and when they're in like 6.5% ballpark range, those two choices on a monthly basis are pretty comparable again. So that helps the buyer definitely, move forward and feel more confident with that approach. We are starting to, I mean, there are definitely areas of the economy where consumer sentiment is definitely starting to slow down, feeling general inflation pinch your budgets, and that difficulty increasing to save, right? But the kind of the size of the demographics behind home buying are substantial, which makes, for example, our forecast right now with mortgage rates, staying where they are and then trending down towards the end of the year, we're still forecasting home prices to grow next year, a little bit, not a huge, a rush, like nothing like pre-pandemic either, softer than pre-pandemic, but fairly on par with what was averaged, say, over the full history before the pandemic.
That's
So,
fantastic.
so if I own a 3-bedroom, 3-bath house in the suburbs of a major metropolitan area, you foresee a little, some appreciation, not, 15 or 20% like a couple of years ago, but
Awesome.
certainly not going down.
Mm-mm.
Safe investment, building wealth. It's a good place to be in general.
Yeah, generally for someone who is thinking of staying for a long period of time. I think when we talk about mortgages and, a lot of my conversations in the past with Melissa have definitely, been talking about how hard it is to do that process that keeps a lot of the upfront expense to buying with a mortgage high. It's not just the mortgage, right? It's also just the regular kind of more transaction costs from commissions to title insurance to appraisals to kind of everything that layers in with this thing. So you still don't want to do it as, very frequently, right? And when the financials, as they are right now with a soft home value forecast in the beginning, tip just less favorably towards home buying, it takes you longer to overcome those upfront costs with the benefits of a mortgage. So there's still leverage, right? Where you put up only 20%, but you get the appreciation on the whole thing. There's still insurance against future rent growth, right? If you lock in your 30-year mortgage, there's still tax breaks. All of that usually accumulate to making it is still a better financial decision to buy, so long as you're going to stay. If you run the numbers, by the way, it's very sensitive to the mortgage rate that the buyer has and that forecast, but so long as you stay around 5 to 7 years in the US on average, it's still a good financial decision to have purchased. There are areas in this country where you really, like on the West Coast in particular, if you think about run those same numbers, you got to stay for a much longer period of time to make home buying worth it. And wouldn't you know, those are the metros where new listings have pulled back the most, right? People aren't moving in this environment because it is incentivized to hold over there. But folks hold, and then they pass on to their kids, to hold on to that access to that wealth.
So what about, let's say I mentioned like a 3-bedroom, 2-bath place in the suburbs or something. What about a more of a second home kind of market area where you might have a
Let's go to
house in the
Louisville.
mountains or house on a lake somewhere in, Minnesota or Texas?
Oh, sure. Yeah. We're seeing some, I would call it market clapback from the pandemic rush, right? So there are, let me take, for example, I live in the Pacific Northwest. I'm right outside Seattle. And if you look at the pattern around the Seattle metropolitan area, you'll notice that downtowns are still soft, right? People not really coming to work. So there's still this, better pressure on, not better from, from the perspective of a buyer, but certainly from the perspective of an owner and a seller. But so good pressure on home values kind of in those kind of prime suburbs, as you kind of imagine. There are some places that experience probably too much heat over the pandemic. So maybe that lake house property might actually be an area where prices are coming down a bit more at this time. But that might have already kind of happened more towards last year. It really kind of, when rates first spiked up and that kind of second home opportunity dried up a bit more. So now it depends locally where I am in this shock wave, a bit of a cycle, right? That said, there are other places that are experiencing additions of supply, right? It responded. So like Austin was a huge booming market that's slow now, probably not just because of a clap back from having boomed and now they're market correcting, but likely because new construction coming online in that area successfully around in Texas in general, and then also tech jobs are kind of declining more than others, and so those markets are kind of slower. So we shared a lot over the course of the pandemic, kind of what that boom looked like. But in terms of the aftermath there, if I'm looking at a place like Louisville, and then up, into the Midwest and then out to Central, you see much more consistent home value growth right now. Also the Northeast, by the way, your Hartfords and your Providence, Rhode Island. So think about that kind of adjacent to expensive Boston and New York strength, up and there in the Northeast. There you see a lot more consistent home value growth almost across the board. But you got a lot other price corrections in other areas for sure at this time.
Skylar, you mentioned kind of rent versus buy comparison
Yeah.
between you.
Yeah.
How does coastal regions, particularly with the rising cost of insurance and a lot of those places, play into that?
Yeah. I think if we add the insurance layer in here, this can become highly predictable. And actually, if you play out this argument, unpredictable for that buyer, and if you play out this argument is a great reason why maybe prices are too high in a lot of these areas, and homes are taking much longer to sell. And in some cases, we're probably even starting to see some new listings come on, as many may have gotten themselves into a situation that they couldn't maintain because insurance premiums increasing so dramatically. These are areas like in Florida, right, where you've got a lot of private insurance companies that are no longer operating. And so now you're using really the insurer of last resort through the state. And I anecdotally at conferences, I'm hearing a lot about, what that buyer sees upon signing into that insurance contract, something that says, not if, but when a hurricane occurs, your premium will increase by some substantial share, not to quote a number that I can't remember too firmly, but increase by some substantial share. And it's starting high. So then, this is a buyer who's being asked to contract. If they need a mortgage, they need this home insurance, and they're contracting in a situation that doesn't offer what the 30-year fixed is supposed to, which is predictability in my payments moving forward because of the insurance element. And so I think in these areas, prices will have to come down in order to kind of clear these markets. And the insurance issue is just simply a real challenge. This is also occurring in California, where you have higher fire risk.
Yeah. Well, Skylar, you have shared a whole bunch of fantastic data for us today. I'm so grateful that you were able to join us again. How can people find out more about, the data that comes out from Zillow on a regular basis and what you offer?
Yeah, data drops at the beginning of every month. And honestly, you can find it in a lot of places, by keeping your ear open, maybe on LinkedIn, if you want to follow any of our economists there. So following myself on LinkedIn or otherwise, we're going to focus a lot on making sure our data is available for everyone to use. We don't sell data to the experts. We turn it free to help people make better decisions. Check out Zillow.com/research if you want to go straight more to the source. There's data you can download there. And I actually personally create a lot of data dashboards to help people kind of explore the data in their own area, hopefully in a friendlier way. And those experiences will continue to get better over time. So check us out. Zillow.com/research is my home base.
I love your dashboards. They're fantastic. And thank you very much for joining us. Rob, thanks for joining us, and everybody that's here. Happy to see you guys, and hope everybody has a fantastic weekend.
Yeah,
See you
take
next
care.
Thank you, Melissa. Thank you, Skylar. Bye.
Bye all.